All right, welcome guys to our second topic of the syllabus. That is our second semester syllabus. So the second topic then is our integrated accounting system and the cost ledger accounting system. So this guys is just a revision of what then we've done on chapter 3, chapter 4, and chapter 5, where then we were talking about material labor and overheads. If you look at those chapters, then you've got a session there that talks then about the accounting entries. Oh, but now that we've purchased then the material, how do we do then recordings of accounting entries? It's fine if then you've never done that session. It's okay. It's going to make then chapter 8 interesting instead of being boring, because it was going to be the repetition of what we've done on those chapters. So that's what we're going to look at. So it's not a challenging chapter. As I've said, that is just a summary or the revision of what we've already done on those chapters. So the outcomes is for you then to be able to administer an integrated accounting system and a cost ledger accounting system. So that's then the point. That's what they'll ask you then to do. You must be able to differentiate between the two systems and also then do the recordings accordingly. Now let's look at the integrated accounting system. We say then with this system, this is a single comprehensive accounting system with no division between the financial and the cost ledger. So that's what then is new then for us. Okay, now what are we talking about when we talk of a financial and a cost ledger? Now you must remember this, guys, and when we talk of a cost accounting, our main focus, we are focusing then on a large companies, production companies mainly. So we've got an idea of a company that is running then a production with then the aim then to make his sales at the end of the day. So on that particular company, we ended up having what we call now as a cost accounts. We say now as a cost account because these are the accounts that we use to develop the cost of the product that we are manufacturing. So you may talk of then your material labor and your manufacturing overheads. Those are your production cost accounts that we have. Then you may add then other accounts there. Also, you've got the financial accounts, because at the end of the day, you've got a bank account and many more accounts that you have that have nothing to do with our production. So we categorize those accounts as financial accounts. But when we are doing the integrated, we say that it doesn't matter whether is it a financial account or cost account. We combine those accounts. There is no division between the two. So it means that the administration of those accounts is done now on a single house. We don't differentiate between the two. It uses the same basis for matters such as inventory valuation and depreciation. Understandably so, because we say that they are being housed in the same venue. So if we are saying that we are using perpetual inventory system, then to evaluate our inventory, then we cannot say that, but in the cost accounts, then it was a different value, because all this information is done in the same place. Then there is no need for a reconciliation between profit in the cost account and the profit in the financial account. So that's what we're talking about. So in other words, when you talk of the integrated accounting system, is your normality accounts as you are doing then in the financial accounting. So there is no change. But look at the integrated accounting system or the cost accounts. Cost and financial accounts are maintained independently of each other. These are the keywords, guys, because even at the exercises that you are going to come across, they are not going to be specific then to you that the company is using interlocking or the company is using integrated. You'll see then at those terms, once they say that in the heading, there's no distinction between financial and cost accounts, and you'll understand that, okay, that means that company is using integrated. But if they say that we maintain independently financial accounts and your cost accounts, then you'll understand, okay, now we're using the interlocking then to do the reporting. Uses the same basic data as the financial account frequently adopts different bases for matters such as inventory valuation and depreciation. Understandable, so guys, because things are being done independently. So at the cost accounts, they can use a perpetual inventory system, whereas the financial accountants on the other side, they are using a different depreciation method. Need a reconciliation between the profit in the cost accounts and the profit in the financial accounts. So because at the end of the day, you may find that there are discrepancies. So you need then to reconcile the profits. Then the interlocking of the two sets of accounts is carried out by the use of control accounts in each set of the accounts. A cost ledger control account is kept in the financial ledger, and the financial ledger control account is kept in the cost accounts. We are going to explain this, but what do we mean about these accounts? Because now we talk of then a cost ledger control account that is going to be there in the financial account. You'll see, because here's the issue, guys. We may purchase then our material, let's say cash. So you look at that transaction and say that, okay, I've got two accounts that are involved here. I've got the material that I'm purchasing as well as bank account because it's a cash purchase. But when you look at your material, you classify it as a cost ledger account. But the bank account, it falls under your financial ledger account. So you've got then the accounts and that affecting then the two sides. Yet then we're doing things independently. Hence, they are saying that to maintain or to keep then at the double entry system, we are not going to say, okay, because we're cost accountants, we're going to debit only our material and that's it. There's no single entry system. We keep always then doing that double entry system. Hence, then we said, okay, the best thing, if then it happens that we've got then those two sets of accounts, let's have then this account to link then to the other side. That is why then the financial accountants, they've got an account that they call it cost ledger control. And on our side, we've got the account that we call it financial ledger control. So instead of crediting the bank account, we are going to credit financial ledger control account. By doing so, we're indicating to the financial accountants, but look, guys, you are going to have a credit on your one of your accounts. Yet on their side, instead of debiting the material account, they will simply debit the cost ledger control account. So that's how it works, and then to keep our double entry system. I'm sure then you may not be clear now about what I'm talking about. Once we go then to the actual exercise, we look at the practicality of it, you'll see clearly then what these linking accounts then how they worked. Of course, again, they take you a little bit back then to those first three chapters, that is chapter 3, 4, and 5, by refreshing your minds about the procurement of a production process, saying that before you can produce anything, you need to procure material, hire labor, and project overheads. You can't wake up then and you find that, okay, in my buildings, I've got the material, there are people that are already here then, ready to work, and also the overheads. You need to procure those things. And these are the procedures when you do then the procurement, purchasing of your material, you know what to debit and what to credit. And when you pay your creditors, you know then the double system that you have to do. Looking at your labor, hiring the labor, when wage are due, then you debit your labor control account and credit your wage payable. Once then they are due to be paid, wage payable then and the bank account is being credited. Your manufacturing overheads, when expenses are incurred, then we debit our manufacturing overheads, then credit accounts payable. Then when the creditors are being paid, accounts payables and your bank depreciation, of course, again, is going to become part of your manufacturing overheads. So that's then the procurement side. Then we start then at the production. Remember again, guys, and when we talk of then the production is always being represented by a work in process account. I think then at chapter 6 in your textbook, then now you dealt then about that. You know exactly what we're talking about when you talk of your work in process account. Then it's representing then our production, and we make sure that then before you can say, guys, I've completed the product. On the debit side of your working process, you must have your material, your labor, and manufacturing overheads. Without those three elements, you cannot complete a product. That is why then when we look at the entries also, then the accounting entries that we have, when we issue then direct material. Now look at this. This is an internal transaction because we've already purchased this material, but now we're just issuing it from our storeroom to the production center. So these are the internal transactions, or then transaction that this is an internal transaction, and you'll simply then debit your work in process account and you credit then your material. So that's the very first debit then that we're looking for in our work in process account. When we issue then it indirect material, then once we say that this is an indirect, therefore it means that it's an overhead. We'll debit manufacturing overheads and credit your material control account. And there are some unusual transactions that may arise where the material is to be returned back to the storeroom, where we'll simply debit then the material and we credit work in process. You'll notice that when it comes to cost accounting, we are so direct when we do then our recordings, guys, unlike in financial accounting. Because in financial accounting, you notice that once you've got your returns with sales, now instead of saying, okay, I'm going to go straight then to my sales account and debit it, we open up then the new accounts, and that is your return, which we are going to close it off against it says when you draw up your financial statement. But in cost accounting, we care less about those things. We go straight then to the accounts that are being affected. When material are returned then to supplier, accounts payables, or the bank account, if then it was a cash purchase, we debit that because we are receiving back our money. Or if then it was a liability, then we reduce then the liability. We no longer owe then that person that amount. Then we credit immaterial because we are taking the stock out again from the storeroom, but not now to the production side, but back then to the supplier. Then looking at your wages, when recording direct labor, is your working process. That's your second debit that you're looking for, and you credit labor control account. When recording indirect labor, that again goes through your manufacturing overheads as a debit, and you credit your labor control account. You must remember that, guys, and when you do then this tier account of the labor control account automatically supposed then to close it off. So you can't have a balance. Carried down and the balance brought down on that account. Is there any question? Amanda, please, and can you stay muted, please? Thank you. Then again, I will look at the manufacturing overheads. Remember, we said that then that's going to be our third debit in the work in process account. But then the indirect ones, we always keep on transferring to in manufacturing overheads. Once again, when we talk of then the manufacturing overheads, we don't put then the actual amount to our work in process account. We take then the applied amount or the recovered or the absorbing then amount. So in other words, then the estimated one. That's the amount then that we take to a work in process account. On the debit side, then you credit your manufacturing overheads account with the amount of overheads applied. They even then write that in italic so that then you are not going to be confused then by taking then the actual amount. Hence, they said applied overheads is overhead absorption rate times actual activity. You know exactly then how to work out your absorption rate, but that rate is based on the budgeted information. You always take then your total budgeted manufacturing overheads. Then you divide by the base that is given for you. And it's going to be the budgeted. And also the base is going to be the budgeted one to get into that rate. Hence, we say that then it's based on the budgeted information, the amount that we attach then to our work in process account. So that's what then we need then to notice then when it comes into the manufacturing overheads. So that's it. Then once again, we finish then our production. We cannot keep then the finished goods in the production side. We need to transfer those goods then back to the finished goods account. So then these are the accounts that you have to do. You have to debit your finished goods control account and you credit your work in process account to indicate that then we've taken this out and you start then making then your sales. If it's a cash, debit your bank and credit the sales. So if it's on credit, accounts receivables debited and sales are going to be credited. Then when the payment is being received, the bank is going to be debited and accounts receivables are being credited. Provision for doubtful debts, you make then those provision for doubtful debts and your profit and loss account. You know how to do that. And also for the cost of sales, because then remember then in your finished goods account, you've got then that value of what we've finished then to complete. So you need then to reduce it if then you are making you've made the sales. Hence then we debit the cost of sales and we credit the finished goods account with the cost of the goods. Remember then we said that in there when it comes to the manufacturing of ads, we didn't allocate it or taken then the actual amount then to work in process, but we've taken the applied amount that resulted then to what we call an under or over absorbed manufacturing of ads. You need then to calculate that, and you're going to be directed in each and every question. But most of the time, we always close off over or under allocated amount to a cost of sales. And reason being, then we simply say that then that adjustment needs then to be done periodically instead of transferring to the finished goods account. We said the best way is to do it then to the cost of sales. But we look at the sales that we're making now and say, okay, let's also deal with that over or under applied amount to that amount, because the cost of sales is a periodic account. We cannot carry on now with that then over the years. So if then we've got that amount debited to work in process too low, under that is resulted to your under applied, and a cost of sale is going to be debited so that we can make an increase to that. But if it's an over applied, we reduce then our cost of sales. That's what we have to do. Okay, that was just a refreshment, just to refresh our minds. But now let's come back then to what is totally new, the integrated and interlocking accounts. Now we want them to look, but how do we do this? So they've given us now additional information pertaining then at the interlocking account. So they simply means then what we've already have then about integrated, it was sufficient. But this is what we need to note again when it comes to interlocking. Interlocking accounts are also known as non-integrated system used by large enterprises that keep more complete costing records that are independent of financial records but linked to them. That link that we've talked about of having then the financial control account in the cost accounts and the cost account control account in the financial side. A separate ledger is kept for all transactions that affect the cost data of the enterprise. All costs related to the manufacturing process are recorded in this ledger. So that's the information, additional information that we have. And they provide us with some also additional advantages. They say that the advantage there of is that the financial accounts contain fewer records. The cost ledger functions independently of the financial ledger, but is also written up according to a double entry system. Hence, we say that then we cannot do away with that double entry system. That is why then we need then to have an account that is going to represent the other side. Cost and financial system use the same basic information. Therefore, the two separate ledgers should, in a sense, agree then to each other. But unfortunately, from time to time, then you'll find that there are discrepancies then that you have. So you need then to do the reconciliation if then that is necessary. Then in the cost account of financial ledger control, control then should be kept then to maintain then the double entry system. In the financial accounts, a cost ledger control account is kept also then to maintain that double entry system. So that's how then we maintain the double entry system. If then it happens that in the same transaction, you've got an account that belongs to the cost side and account that belongs to the financial side. That's what then they mean then with that information. So in that diagram then they show you then some of the cost accounts that you are going to come across with, and some of the financial accounts that you should expect. So you've got then those production cost account, which is your material wages, manufacturing overheads, and a work in process. And also then some additional cost accounts that some of them have nothing much then to do with the production, your finished goods control, cost of sales, and also your costing profit and loss account. So then to link then at this account, we've got then that financial ledger control account. Hence they say na plus that account. And also the financial side, then those are the accounts that they have there, plus also then the cost ledger account. So that's how we do this. And they provide with the example of transactions that do not affect the cost ledger at all, because both accounts affected will appear in the financial ledger. Your non-current asset purchased, because if then you purchase a non-current asset, being with cash or on credit basis, it will never affect then the cost accounts, because you'll have then the non-current asset that you are purchasing and the bank or a creditors. Both of those accounts are financial accounts, and then the other accounts that we have there. All right, so that then we can start then to understand much better than what we're talking about. I've selected then that question 8.2 to use it and so that we can have a better understanding of then the theory that we've just covered. Look at that question. We said that Kidman's Limited keeps only one set of books for all its cost and financial transaction. The company's accounting period ends on the last day of February of each year. Now look at the very first sentence in that heading. They say that Kidman's Limited keeps only one set of books for all its cost and financial transaction. And that information is sufficient, guys, and to tell us what can the company is using which method between integrated and interlocking. So is there anyone then who can tell us what can which method is being adopted by Kidmans Limited? If then they are saying here now they've kept only one set of books for all its cost and financial transaction. That is clear. Then it means that the company is using integrated, because there is no differentiation between the cost and financial transaction. They've got only one set of book for all those transactions. So you'll pick up then from the heading then which method or system is being used by the company. The following information regarding the company's transaction during the year ending 29 February 2024 has been supplied to you. You've got the material purchase on account 70,000, direct or material issued to production. You've got a direct one of 50,000, indirect of 2,200, direct material returned to supplier is 1,000 rand. Wages paid by check, direct labor 44,000, indirect labor 2,000. Manufacturing overheads incurred on credit is 4,000. And the question carries on then on the next slide, where they say that manufacturing overheads are absorbed at a rate of 30% of direct labor cost. The under or over absorbed overheads are adjusted against the cost of goods sold for the year. So they've given you then the directions on how are you going to write off then your cost of goods. Then a cost of goods completed during the year, direct materials 46,000, direct labor 38,000, manufacturing overheads. They say that you are going to assist them then with that. Credit sales of 80% of the units manufactured during the year. No cash sales take place. It gives you a total sales amount of 90,000. Goods returned by customer 4,700 with a cost price of 3,600. Selling and administrative costs paid by check 6,200. You are required then to record the above transaction in the ledger of Kitmans Limited for the year ending 29 February 2024. Balance all the accounts at that date, clearly indicating the gross profit as well as the net profit. So that's then the requirement. So this is These guys, then we just going then to follow again the accounting way of doing things. We open up then the ledger accounts here. So this is your 8.2. We look at then each transaction and we identify now the accounts involved. Then we just notice okay, now which account is going to be debited and which account is going to be credited. So that's simple like that. Excuse me. Look at the first transaction. Material purchases on account 70,000. So the mere fact that they say that it is purchased on account, then you know that okay, it means that this is a credit purchase. So the accounts involved there is your material account and accounts payables. Then open a trade account there. So these are the two accounts that are involved. We purchased this material by 70,000. So accounts payables 70,000. Material here 70,000. So that's simple like that. And you say we're done with that transaction, and you got the marks that we're looking for. And you need then to understand this guys because especially the kind of the test, because when it comes into the multiple choice, you are going to give a transaction. So you need then to identify okay, now which account is going to be debited and which account is going to be credited. So please then be careful of that. It's not that now you are going to write it down, because that one has got a problem. I've tried it and it opens up a can of worms. Material issued to production, direct is 50,000, indirect 2,200. So we've got now, this is an internal transaction. We've got the material issued to the production. That we need then to look at it. So we've already have then the material account. We are not going then to reopen it again because we've already opened then the material account. But now we issue immaterial to the production. The production is represented by a work in process account. Remember, then we've talked about that. So then that's the account now that we're going to open. And we say here, work in process, we've got 50,000. On the debit side here, you've got then your material of 50,000. And that's it. Then you've got also the indirect one of 2,200. That's an indirect material again. The material account is already there. What we need then to open is manufacturing overheads. So you simply open your manufacturing overheads, come to this side and say now manufacturing overheads of 2,200. Then you come then to the debit side of then your manufacturing overheads and say now the material 2,200. Hope then that is clear then to everyone. Then we move on to the next transaction that we have. The next transaction, they say now wages paid by check. We've got a direct labor of 44,000 and indirect labor again of 2,000. We need then also then to look at that. You see then which accounts then are going to be involved. So, excuse me, we need then to open up then the wage.
Sorry, sorry sir.
Yes.
Le transaction yelantsike material return yayo to supply libela.
We have a return. Oh, sorry then for that. Then I've skipped then that transaction. Thank you for that. All right, then we've got then this transaction then, guys. Sorry then, I've skipped then that. I thought that we've dealt with the material. Direct material return to suppliers of 1,000. So this is a return then back then to the supplier. So it's going then to reduce then the material that we have in our material control account. So we are going then to open up then that the only one account then that we're going to open, which is banking. Bank for what now? You can open up then the bank. Remember, we said that when it comes into the cost accounting, guys, and now we become so direct when we do then our recordings. So we've got then these returns. So our understanding is that then, okay, looking at our first transaction, we had then the purchases on credit of that 70,000. So we simply understand and said, okay, therefore it means that this return that we're talking about, it was based on that 70,000. So it means that from this 70,000 that we had on the debit side, now we're making a credit. So it will be your account payables, then 1,000. Then you come to your account payables and say material 1,000. Instead of saying then, okay, let me open up then the account, the returned account and blah, blah, blah. We care less about those things. We go straight then to the accounts that are being affected. Thank you then for that reminder. Now we move on then to the wages paid by check. Direct of 44,000, indirect of 2,000. They've been paid by check. That's what they say to us. So we open up that wage control account. So first thing then, sorry guys, then can you please then stay muted? Thank you. Let's not then forget guys then to mute then our mics. We only open them if we've got a question or anything then that we want to say to the class. So we've got this wage control account. The direct amount is 44,000. So we will credit our wage control account with a work in process. That 44,000. Then we debit then your work in process account. We've got the wages there of 44,000. That's the second debit that we're looking for in order then to be able then to complete our product. And we've got also then the indirect labor of 2,000. We'll credit again this with manufacturing overheads. Remember that 2,000. And we go then to our manufacturing overheads. We've got the wages here. with that 2,000. So we're done then with that transaction. We move on then to the next one. They say manufacturing overheads incurred on credit. We've got to 4,000 of the manufacturing overheads that we incurred on credit. So we know that the accounts that are going to be involved there, we've got the manufacturing overheads and what? Anyone who can tell us? We've got the manufacturing overheads and accounts payables. Thank you. Debit and your manufacturing overheads with that 4,000 and we credit the accounts payables. 4,000 with that amount. So that's it. And it's in a manufacturing overheads or the next transaction or information that is given then to us. They say manufacturing overheads are absorbed at a rate of 30% of direct labor cost. Okay, thank you for that information. Then again, at the under or over absorbed overheads are adjusted against the cost of sales. Yes, we appreciate that. Cost of goods completed during the year. Direct materials 46,000, direct labor 38,000, manufacturing overheads. Then they say now you need to calculate that on your own. Let's first that with the manufacturing of absorbed because we were given that we absorb our manufacturing overheads at a rate of that 30% of direct labor cost. So that's how then we are going to allocate the overheads to our production. We use then at that 30%. So we simply then say, okay, they've made then our life then easy because you simply come then to your work in process account. Look at your work in process account. You've got to 44,000 there, guys. You see that in the work in process account, the 44,000. So we'll say, okay, therefore it means work in process. We have then to credit manufacturing overheads and debit our work in process with the manufacturing overheads. You simply take then that 44,000 times then the 30%. So then it means that your manufacturing overheads absorbed is going to be 13,200. 13,200. Then we've got all the three elements that we're looking for in order then to complete then now the product. So we've got the material wages and your manufacturing overheads. We are happy with that information and they said to you, ask, okay, if it happens that you've got any over or under absorbed overheads, you have to adjust that against the cost of sales. Now the question is, how are we going then to know that we've got it over or under absorbed? You simply go then to your manufacturing overheads account and you balance that account. That's how you are going to see whether is there any over or under allocated amount. That simply means that, guys, in this account, we do not have a balance carried down and a balance brought down. We have to do the balancing of this account. Any differences that we have, it will mean it's an over or under allocated amount. So you've got 2,200 plus a 2,000 plus a 4,000. That gives you this side a total of 8,200. So the credit side is our biggest side. So we're going to balance with that 13,200. So we need also this side 13,200. So the difference then I will go then to cost of sales. Difference of 5,000. So if we're going to debit, guys, the manufacturing overheads with that 5,000, and we credit cost of sales. Cost of sales. We come then to this cost of sales, and we say that we're going to credit them with the manufacturing overheads. 5,000. What does that mean? Is it an over or under allocated amount? The fact that then, guys, then we credited the cost of sales, it means that then we've had an over allocated amount. We want to adjust then now the amount or the debit side of your manufacturing, I mean your cost of sales. It simply means that it was an over allocated amount. So that's an over this amount. That's what it means. So we have then to reduce that one. Thank you. We've done then also then with this. Cost of goods completed during the year, direct material 46,000, direct labor 38,000, manufacturing overheads. They say that you need then to work out on your own. But then you know then what the accounts then that are going to be involved in is your work in process account with finished goods. So we come here to open up then our finished goods account. So we've got a finished goods account from the work in process. And guys, remember this, and you cannot record them one by one and say material, labor, and manufacturing overheads. You need then to record a round figure, which then is a total of the three when you record it on the finished goods. Because now we're talking about the finished goods. It means that then it's a combination of the three. Your material is there, labor is there, manufacturing overheads. Once you combine them, you come up then with a finished product. But then in this question, because they wanted you then to work out then your manufacturing overheads, hence then they provided you with these values then one by one. So you need then to calculate again your manufacturing overheads. How are we going to calculate our manufacturing overheads? Anyone then who can guess for us? Our manufacturing overheads, guys. Anyone who can assist us? This is the figure that we're looking for, the manufacturing overheads. You go back up there, guys, and we were told that our absorption rate is 30% of indirect labor cost. So again, then you look at the direct labor cost just above then that manufacturing overheads of the finished product and say, okay, if then the finished one is 38,000, what is 30% of that? So you say, okay, then I've got 11,400. So the 11,400 is the value of my manufacturing overheads in this finished product. Then you add then to the 38,000 as well as 46,000. And you have then your round figure of 95,400. And you come then to your calculation and say finished goods, your 95,400. You debit your finished goods, 95,400. That's it. That's how then you do it.
bengicela ukuphila ndikuva ngathi usenayanza na-11,000.
Okay. Let's go back again down to the question. If you look at the question, this is the statement then that we used. of manufacturing overheads, where they say manufacturing overheads are absorbed at a rate of 30%. 30% of what? Of it direct labor cost. Remember then we've used then this and in order then to allocate in manufacturing overheads to our production. Now they say to you then this is the cost of the completed during the year. Immaterial 46,000, direct labor 38,000. This is your direct labor. And in your mind, you know that okay, to allocate overheads is always 30% of the direct labor, whether then is before the production or at the end of the production. You maintain then that 30% when it comes then to manufacturing overheads. That is in your mind that your manufacturing overheads is equal to 30% of the direct labor. So this is then 38,000, which is now your direct labor of the completed units. So you take then that 38,000 times 30%. Then that's where then you'll get then this 11,400. And say, okay, then this is the value of my manufacturing overheads if then these units are completed. Then you add then the 3. So that then you arrive then to this 95,400.
All right, Senebo.
Thank you. All right, then we're done with that. The next transaction says to us in a credit sales of 80% of the units manufactured during the year. No cash sales take place. Got 90,000. So then that 90,000 is our credit sales. Because then we don't have cash sales. So the accounts and that are going to be involved there. We all know that okay is going to be sales and what?
Account receivable.
And accounts receivable. Thank you. We debit then our accounts receivables, sales 90,000. Then you come then to your sales. This is an income account. Accounts receivable 90,000. And that's how then we do then our recording. And remember then we've made these sales and they've indicated then to us guys and say it's 80% of the units manufactured. So that 80% then is there then to help us because then if then we've got this sales of 90,000, that is the sales amount. Therefore, we need then to go back then and adjust our finished goods account. That's why then you've been provided then with that. Okay, out of then what you finished, then you must know then that is only 80% that is being sold. So you need then to calculate then your cost of sales. And then you adjust then your finished goods. So if then it's 80% of the units manufactured. So we don't know the number of units, but what we know the value of that the 100 units or the completed units. That is 95,400. Then you take that 95,400, you calculate 80% of that. Then you'll simply say this is going to be cost of sales 76,320. Then from the finished 76,320. Hope we are happy then with that adjustment then of finished goods account. Then they said the goods returned by customers, cost price 3,600, 4,700. Remember then what I've said then to you that then in cost accounting then we are so direct. So we just simply go back and said, okay, now these goods returned are from this 90,000. We've made these sales here, then off credit sales, hence we've got accounts receivable. So we simply say again, now we go and do the adjustment and say, okay, accounts receivables again of that total amount, 4,700. We don't waste our time by opening up now the returns and all those things. It's only in financial accounting whereby then we say that we cannot have a debit entered then in the sales account, but in cost accounting we do. That's how then you'll get with that transaction. Then you've got also the cost price of 3,600. So we need also then to take back then to our storeroom then that 3,600. So you come then to your cost of sales and say now finished goods 3,600. And you come here and say now cost of sales 3,600 to then your finished goods account. Then the next transaction that we have here is the selling and administrative cost paid by check 6,200. That's clear then for you guys. This is paid by check. Selling and admin. Let me open up then the bank account on the other side. So we've got this selling and admin of 6,200. 6,200 there. And you come to the bank. Selling and admin 6,200. That's it. So, and they say that we need then to balance all the accounts at that date, clearly indicating the gross profit as well as the net profit. So we start then to go back then to our material account and balance that account. $52. So obvious then the debit side is our balancing side. We'll balance with that side. Therefore, then we look at our balance carried down here, which is going to be 16,800. Then you record on the debit side as your balance brought down 16,800. That's how then you balance out. Then we move on then to the next account, the accounts payables that we have there. So this side it gives us 74,000. So we're looking for 74,000 also on the debit side. So that means then your balance carried down will be how much? 73,000. Then your balance brought down at 73,000. That's how then you balance that account. Come then to the next account that we have, work in process account. Obviously then let's add and see then how much then do we have then on the debit side. Your debit side is 50,000 plus 44,000 plus 13,200. So it's 107,200. So we are looking at 107,200 also on the credit side, minus then the 95,400. So your balance then this is your balance carried down 11,800. So it will be your balance brought down on the debit side 11,800. Asset manufacturing overheads, we've already dealt with it. Remember, we said that in the manufacturing overheads, you cannot have a balance carried down. That balance that you have in that account, it will determine whether you've got an over or under allocated amount. The next account that you have is your wage control account. Again, now we've indicated, guys, in that in the wage control account, you cannot have then the balance. So if then they say that let's come and do the balance then to this wage control account. So what we're expecting now that we raise these liabilities at the end of then the month, then we need then to pay our employees. So then at the bank account, we've got then that total of 46,000. So the account is automatically going then to be closed on its own. Then again, we come here and say wages 46,000. That's what then we have to do then with the wage. Cost of sales, we have then the balance carried down and balance brought down in that account. What do you think, guys, when it comes down to the cost of sales? Taking note then of what they've said then in our requirement, they say now balance all the accounts at that date, clearly indicating the gross profit as well as the net profit. So once you've got the cost of sales, I've indicated earlier on that now this is a periodic account. So it means then we need then to close it off at the end of the day. So we don't have then the balance then brought down and carried down in the cost of sale. In fact, if then they say that let's also have the gross profit and the net profit. So we'll take this then to the profit and loss calculation. Then the profit and loss, which is then the balance of 67,720. So we balance then this account then to that profit and loss account. And remember then the profit and loss account then represent then in some kind then the income statement. Cost of sales 67,720. So that's what we'll do then on that account, and we're done with that. Finished goods account. Question again, do we have then the balance carried down and brought down? Yes, because that's an asset account then that we have. So we'll do then have then those balances on that account. Balance carried down. What is our total? 95,400 plus 3,600. So that gives us 99,000. Then with then the balance carried down of 22,680, and you have then your balance brought down on this side 22,680. That's it. Then when we look at then the sales, because we need again then to show then the balance that gross profit. So when you've got come then to e sales, you'll close these sales off then to a profit and loss. So you've got that 90,000. We need also 90,000 also this side. So our balancing figure then on our sales is going to be 85,300 to the credit side. We've got sales here of 85,300. And we're done with that sales. Accounts then are receivables. Yes, we do have a balance here. 90,000. Balance account 90,000. Then your balance carried down 90,000 minus 4,700. 85,300. Balance brought down 85,300. Selling and admin. Now, because then they say then to you guys, then we need then to this account then to indicate whether the gross profit and the net profit as well. So before we close off then the selling admin, because we're going to close it off then also then to the profit and loss. Is 6,200. But before we can do that, let's indicate then our gross profit. On this profit and loss account, so it's going to be 85,000. Okay, we've got 5,300 as our balancing, 85,300. Therefore, the gross profit that we have is 17,580. If you like it, you can call it then balance carried down or balance brought down. Gross profit again this side 17,580. Then that's when we can brought in then the selling and admin of 6,200. Then we redo then again the balance of that. Yeah, the net profit 17,580. Therefore, then our net profit then that we have is 11,380. So we've managed to indicate those as per the requirement. Then we've got then our bank, which is it has got an overdraft. Balance carried down 6,200 plus 46,000. That give us 52,200, which is 52,200. Also, then your balance brought down 52,200. That's it. Then now, how we balance and then the accounts. And we finished then the exercise. So looking at this exercise, guys, then it was based then on the integrated. So if you look at this question, then there's no distinction between the financial and your what you call it, your cost account. So it was just then to show how to do then this G account normal or the same way as the financial accounting side or financial accounting. What I will ask you then to do is to try to attempt, guys, then now 8.4. The next video then that I'm going to post it is going to be based on that. And if you look at that, then question is whereby then we do the integrated. It's based on the integrated. So the next video is going to be integrated and the reconciliation. Then I will be done with the chapter. So I think I will be able then to post a video by Tuesday. Then it means that after that, even next week, then we will start then the third topic. So, and we're only left with one topic to finish the syllabus. So within no time, we're going to be done with our syllabus. So we will finish the syllabus soon. Thank you. Then that's where then we end then our session then for today. Remember again, as the test I've told you then that the test is going to be on the 27th.
From which chapters?
Chapter 7 and chapter 8. It will be based on those chapters. I'm stopping the recording. Thank you very much.